Put this down. Yep. Um, okay, so we were discussing just before our midday break that if you want to compute the cost of equity and cost of debt, then these are the components that actually measure the required returns on the long-term capital of a listed company. Now, if a company needs to commit this long-term capital to an investment project, they need to know what would be a good required return to people who provide us the finance. So, two main broad categories of finance: equity and bonds. Yeah, of course, your textbooks talk about preference shares as well. But I think in practice, you will find mostly that you use equity and bonds only. Yeah. So to make sure that you know how to calculate this well for your assignment and also for practical reasons, we will focus on the details of cost of equity, and then I'll show you also how to get the cost of debt. So to give you a background on cost of equity, well, we have a theory called portfolio theory. Now, portfolio theory suggested that when you are thinking of new investments to include in your business portfolio, you must not just consider the individual risk and individual returns from that project, from that new investment. You must also consider the risk relationship of the new investment with your existing business. So your existing business is a portfolio and is considered to be one asset, and this new investment that you want to bring in will be the second asset, and hence the term two asset portfolio. When you read finance books, you will see they always talk about portfolio theory in terms of two assets. Does not mean that there are only two. It's just that your existing group of assets, your existing portfolio is one asset, and the new investment that you're considering will be the second asset. So it will always be a comparison of two assets. What portfolio theory has been able to do is to show us mathematically that diversification can help you remove the individual risk in your business portfolio. However, companies will still be affected by market risk, and for us to provide compensation to providers of finance, especially shareholders, for us to provide compensation to our shareholders for market risk, as directors of a listed company, we need to have a model. And the model is, of course, the capital assets pricing model. Yeah. Now, CAPM, as we call it, capital asset pricing model is a beautiful model because what it does is it takes the risk, the market risk measure, which is beta value, and puts it in an equation which we call the securities market line. And this securities market line then becomes a formula for us to find the KE, the required KE. Yeah, maybe we can look at the securities market line here. I have put here some links to where you can go and find beta values. Let me show you a graphic of yes, this should be good. SML line. Yep, that's good. Securities market line. And let's see what this says. Expected return, beta value, and the slope is based on that formula here. Expected return and market return minus risk-free return. Yep. I'm looking for a nice simple one because somebody keeps coming up with a good one, a better one. Yeah. I think this might be good enough. Yeah, good and simple. Let's copy it in and let's paste it here. Oh, it's nice and big. Okay, there you go. Now, this SML here stands for the securities market line. Yeah. So what does the securities market line do? The securities market line equates required returns to market risk as measured by beta value. That's what it does. It equates required returns to market risk as measured by beta value, maybe a bit smaller here. Yeah. So if you look at this securities market line, what we have on one side is, on one side of the graph, if you will, is the beta value. Yeah, like I said, beta value is a measure of risk. How much of the market risk you absorb. How do you interpret beta value? Well, first of all, you need to understand what's market risk. Market risk is simply fluctuations in the composite index of our stock market. Yeah, for example, in Malaysia, for Bursa Malaysia, it is FBM KLCI. Yeah, Financial Times for Bursa Malaysia Kuala Lumpur Composite Index, very big name. Why? Because we use the FT Index Company. FT Index Company is like one of the world's best recognized index companies. So we ask them to calculate the index for us. Why? Because you will find that we are still an emerging market. An emerging market need to make their place in the world stage. So we ask FT Index Company to measure our composite index so that all our data that we have, our market data, will be more readily accepted by international investors. Yeah. So that's basically the idea. Okay, so this is the composite index. How do we measure the composite index? Well, let me show you. Yeah, we'll go through this step by step. What I have done is I have downloaded some pages here. See waiting room. Let me get some people in. Meet all. Okay, that's good. And okay, this is our composite index as per Bloomberg. Now, if I was to ask for a 5-year chart and view the full chart, I think that might be an idea. There you go. You will get the composite index. Yeah. So currently 1652.49. Yeah. As said, close 65249. Now, if I was to just log this in, let's see if I could do that. So maybe I call this 2020. The index end 2020 is 1629, isn't it? Yeah. So I will take it as 1629. Yeah. Okay, index. and then maybe I want it for 2019, 2018, 2017, and if I can go back 5 years, I should be able to go back to 2016. Yeah, it would be nice if I can get it for 2015, but I'll have to find it separately. So this is what you will do if you are going to get your market index, which you will of course need for your assignment. So maybe we can do that part of your assignment right now. 2019, this is December, yeah, mid-December, 1812. So January 3rd, yeah, 12, 20, 12, 13 or 12, 20. Okay, that's fine. 1 year ago, it was 1610, not much change. Yeah, 1610 went down and came up again, isn't it? Yeah, and then the previous year again, 928 7 July, June. Did I overshoot already? Let me go down and see. Okay, this is 2019. Yeah. And we already got our value for 2019 just now. So we need our value for 2018. 2018, 1207. December 14th is good enough. And the value is, oh, because I need to go up again, sorry. There you go. Yeah, 1214. Let's take it around there. What is the value that I'm looking at here? Showing me volume. Yeah. Looks to be at 17 something, just below 17. If I block the there you see it's too far up. 1116, 11.2. There you go, 12, yeah. 10, 12, 19, 10, 26, 10, 11, 02, 11, 16, December. Okay, 07, there, this is the one. And we wanted 14. 1661, yeah. Looks like year end, there's a trend, yeah. It hovers around this this price, yeah. So this is why sometimes people use indicative, and then again all the way March, February, January, and we come to December. December 15th is nice, 1753. 1753. Just doing a rough estimate here. Maybe you might want to do something more precise when you're working with this. And again, January, here we go. And December 16th is good. 1638, I think I will take it as 1638. And let me push the envelope right to the end. And 1692. I will take 1692 as an estimate, yeah, of what it was for 2015. So if this is the market index, the returns on the market index are simply the return, the index at the end minus the index at the start, divided by index at the start. So for 2020, the index at the end, yeah. So if I put here returns percentage, it would be the index at the end of 2020. We are nearly at the end of 2020. 1629. Yeah. Maybe in brackets might be better. 1629 minus the index at the start of our analysis 1 year ago, divided by index 1 year ago, expressed as a percentage. Yeah, for those of you who want the Excel tips, that's what you do. And you will get your returns 1.18. Yeah, very small returns. And then for 2019, you will do the same thing. In brackets, 1610 minus the previous year's index divided by the previous year's index. Why? Because it's changed from previous year to this year. Yeah. So divided by 1661 again as a percentage. And of course, this time it is negative. So if I was to copy this formula and I continue all the way down here, then I would get my 5 different returns. Yeah. And maybe I can just put it to 2 decimal places, yeah, so that it looks neat and nice. So this is how I work out my required returns. Now, if a company's stock, if the shares of a company listed on Bursa Malaysia moved more or less with the market, meaning to say when the market went up 1.18 during that year, this company's share price also went up by about 1.18, and when the market was down by 3%, this company's share price was also down by about 3%, or at least proportionately the same proportion. When the market went down 5%, this shares also went down by 5%, so on and so forth. Then we will say this company, more or less, the share price mirrors what is happening in the market. So we will say this company is almost 100% like the market. And as we mentioned this morning, 100% as a decimal is 1.0. So when we say beta is equal to 1, it means you are 100%. Your returns fluctuate 100% similar to what you have on the stock market. Yeah? If your shares do not fluctuate as much as the market, if your fluctuations are less than the market, or you have fluctuations but they don't follow the market, then your beta value will be less than 1. If your price fluctuations follow the market and in fact are more than what the market is, then you will find that the beta will be greater than 1. Yeah, so I have actually shared with you those 2 web pages that I've shared with you. One is this one, in front analytics, where you can see the beta value for Maxis. Yeah, if you can get a 5-year beta is better, but they have got a 3-year beta. Yeah, you have a levered beta. Levered beta means adjusted for the gearing of Maxis, which will be nice, or they also have given you unlevered beta. But we normally stick to reality and take the levered beta for Maxis or for whatever company that you're looking at. Yeah, so you can get your data from here so that you can measure the relationship. So here 0.63 means that the fluctuation in the share price of Maxis is about 63% similar to the fluctuations in the composite index over the last 3 years. Yeah, that's one way of looking at it. This in front is a good website. Yeah, They also give you a small write-up on beta. You see, this is what beta is all about. It's definitions and all. Then they also do their GPRV analysis. Yeah? So GPRV stands for growth, profitability, risk, and value. Yeah? So they do this analysis and they compare this with international telcos, the other telcos, like international peers. Yeah. And of course, you have to subscribe to this, but you can have a free trial if you want. And I think free trial will be okay for you because you're just going to do it once for your assignment, and then you'll be okay. So you don't really have to spend money, and you can get a lot of good information. Yeah. So if this is Maxis, the green one is Maxis. These are the international peers. So one look at it, you can say, wow, okay. In terms of profitability and low risk, the share price of Maxis is slightly better than the international peers, equal to or slightly better. You see this beta value Maxis, 9 international peers. I don't know how they call this 9. Well, here they have called it 0.63. Okay, sometimes these values are a bit weird here, so take it with a pinch of salt. But if you look at overall this graph, what it does tell us is, okay, Maxis is very strong on profitability, good profits with low risk. In terms of growth, there's no telling, but international peers seem to have a greater push towards high growth. And in terms of valuation, most of the valuation is fairly valued because this side would be undervaluation. So looks like the telco sector internationally might be undervalued, but Maxis seems to be okay because it's not very much represented on the undervalued side. Yeah, so you will get all this kind of analysis to actually help you describe the company, describe the company's financing, and this is the kind of information that you will need. Yeah, please do not repeat back what you did for your FAM. Yeah, we want to talk about the listed company. We want to talk about their financing strategies. We want to talk about the external sources of finance that they have. Those are the things that we want to talk about. Yeah, and there's another one called Finbox, sorry. And so here you see a 5-year beta for Maybank. And in this web page, you can also do it for other companies. You can also do it for Maxis here. They compare it with the other companies here. So Maybank, CIMB, this is the average here. Mbank, RHB, Hong Leong, and Affin. Yeah. So then you can get your beta value from here. As long as you get a beta value from any reasonably respectable web page, you will be okay. Now, is it possible that if one person takes their beta value from this website, the number will be different than from another person taking the beta from another website? It's almost guaranteed that the numbers are going to be different. Yeah, because they have different time scales, they have different standard error assumptions and things like that. But it should generally be in the right region. Yeah. And I think, Francis, your examiner is more interested in whether you know the methodology or not. Yeah, so if your methodology is right, then you should be all right. Yeah. Okay, so this is where you get your market information from. Back to our Excel worksheet. So now if we have these returns already, and if we compare a company's share price fluctuation with the fluctuation in the returns in the market, you need to be able to describe it with a relationship, and that relationship is called beta value. Yeah. So if you notice this equation, this is called SML, Securities Market Line. securities market simply means stock market. Yeah, so this is the line representing the stock market, and because it is a straight line, it connects 2 points. It connects a point along here. You see, this graph shows you what we call the independent variable. That's your beta value, or independent axis, if you like. Yeah, so this is the independent variable, and the returns are the dependent variable because they dependent variable, yeah, because they depend on the relationship, the risk relationship. Yeah, so these are expected returns. Expected returns depend on the beta relationship. What is beta? Beta is a measure of risk, yeah, a measure of fluctuation. So if I take the returns on the stock market, these ones, yeah, this is called RM. This is RM, market returns. And if I take the projected or average market returns, and then I look for risk-free returns in the market. So, well, there's some academic debate. If you read some articles by Aswath Damodaran, he's written a few articles in this area. It happens to be his favorite area, one of his favorite areas. How do you define the risk-free rate of return? Different people define it slightly differently, but for our purpose, we can take the risk-free return as the return on MGS, yeah, the average return on Malaysian government securities that are short-dated. So let's see, yeah, if I was to say returns Malaysian treasury bills, then I should get a pretty good measure. Yeah, there you go, BNM securities yield. I hope they don't ask me to download something. So, yeah. Okay, Bank Negara has migrated. Okay, this is the bond market, also migrated. So we need to go 31st December to access them. Please replace them with BNM mold. Okay, let's try that. BNM old. Oh, okay. Yes. So you get your bond market and things like that. Yeah. But I didn't want this. I wanted the treasury bills, yeah, securities yield. So I wanted this one, and so I will just key in here BNM old. We are waiting. There you go. So what are the trading yields? 3 years and all that are too much actually. If we have the bills, this is the one. Up to 3 months, 3 to 6 months, this is fine. Yeah, Malaysian treasury bills, Islamic bills, Bank Negara notes, this is about 1.71, 1.72. So RF for our purpose would be about 1.71 or 1.72. Yeah, you could take that. Not very exciting times, isn't it? Yeah. So if this is RM, RF, the risk-free return, let's say it's 1.72%. So that is the return you can get if you invested in the stock market in government treasury bills and bonds, because they are virtually risk-free. And so now what we are saying is this, in this model, if you can actually make an investment in the stock market and earn a return of 1.72, which is virtually a risk-free return, then every other share in the market which has some degree of risk must give you a return at least 1.72 and then some. Yeah, 1.72 plus a compensation for the amount of market risk that it absorbs. So if I then took RF and RM and I joined the two dots, I would get a straight line. That straight line would be called SML, and that straight line, y is equal to a plus bx, isn't it? Would give me a measure of required returns. How? Required returns. This line would give me required returns by saying a plus bx, where a is RF because that's the constant, plus where b is the slope of the line, and the slope of the line is determined by the relationship, that means by beta value. So plus beta equity of whatever share that you're talking about, multiplied by market premium for risk. So whatever the market premium for risk that is given by the market, and how much of that you absorb, that would determine your required return. Yeah, market premium or risk. There you go. So these are the components you need. This is the data that you need. You need to know the risk-free return. You need to know the equity beta for the companies that you have selected, and you will need to know market premium for risk. How do we measure market premium for risk? Market premium for risk must always make it positive, yeah, cannot be negative, otherwise this formula will get messed up. So how do you make it positive? You can say that going forward, I believe the market is going to go up. Going forward, the market is going to give very good and high returns. Then market premium for risk will become positive. Yeah, market premium for risk, by the way, is RM, the market return, minus risk-free return, RF. Yeah. Okay, so required return on shares can therefore be determined by the risk-free return plus the average market premium for risk multiplied by the beta value for this particular share. I just use the word beta value generally, but what we mean here is the equity beta. Yeah? So risk-free return, average market premium plus, let me say, equity beta. So beta on the equity shares, yeah? Equity beta value. So required return in terms of formula, if you like, RF plus RM minus RF, that is the market premium for risk I told you just now, multiplied by beta value. So let's take an example. Let's say if we have three companies here, company A, B, and C. Company A's beta value is 1.05. It's a bit more or less like the market. The risk-free return, say, is 5%, and we expect the composite index to go up by 15% because they say in post-COVID it's going to bounce. Stock markets actually around the world have already started bouncing. Yeah, if you have been following the markets, you will know that markets have already gone up. So, as they say, the easy money in the market's gone. Yeah, now it will come back to technical analysis and fundamental analysis and things like that. So, if the risk-free return is 5% and on average the market return is 15%, what's the market premium for risk? It would be 15% the market return minus the risk-free return, which is 5%, which in this case happens to be 10%. So if I multiply by beta value, what is beta value? Beta value for company A is 1.05. So now, if we want to add the multiplication of this, we would get 10 multiplied by 1.05. That is the risk premium applicable to company A shares. Yeah, 10.5. To that we add the risk-free return, which is of course 5%. Yeah, and we will therefore get overall required rate of return as 10.5 plus 5, which is 15.5%. So this is how we use the CAPM model to actually get the required rate of return. So could you please do it for me for company B and C. Yeah, I can bring this closer down. Maybe I can make this a bit smaller. Using the required return formula, so we are working to practice this formula here. RF plus RM minus RF. Okay, RF market premium for risk for all three companies is the same. Yeah, because market returns are 15 and risk-free is 5. But if that's the market premium for risk, it applies to all shares. Yeah, first thing to note. Second thing to note, the required returns will be determined mainly by the changes in beta value only, because risk-free return, if it is 5, then it is 5 throughout, isn't it? What is different? What is different is the beta value. Yeah, for company B, the beta value is 1.86. For C, the beta value is 0.68, less than 1. So company A shares move more or less with the market. Company B shares are volatile. Company C shares are probably less volatile than the market, and they don't necessarily move in line with the market. You know, when you hear the financial news, they say that gainers led losers today, that so many shares went up. 250 shares went up, but 100 shares went down. So generally, shares will rise and fall in line with the market, but never all of them. Yeah, there will always be some who are outside the general trend. Yeah. So if I take the market premium for risk multiplied by beta value, that's the value in the brackets, this one here, what I will get is 10 multiplied by 1.86, 18.6 plus 5. So then I will get 18.6, which is the risk premium on this share. This share must give me returns 18.6% over and above the risk-free return, which is 5%. So the required return on this share is 23.6%. And the same thing for company C. The beta value is only 0.68, so it does not absorb very much of the market risk. Multiplied by 10, that's the market's premium for risk. So the loading is only 6.8%. So this shares must give us returns at least 6.8% over and above the risk-free return, i.e. 5% plus 6.8%, which is 11.8%. A very nice, clean, simple model. Yeah. There you go. That's how CAPM gives you KE. So this required return on each share, these are the measures of KE. These are computations KE. One way of how you can work out KE. Okay, lest I forget, I want to recommend that please undertake a personal activity, if possible this evening or something like that, to prepare short notes on various sources of long-term finance, because your assignment requires you to talk about external sources of finance. This will definitely help you if you can prepare some notes on the various sources of long-term money. Yeah, that will definitely be very, very useful. Yeah. Maybe just some short notes today, so that if you have any questions to ask me, you can ask me tomorrow. Yeah. So start doing some reading with purpose today, as it were. Yeah.
Sir, how did you get the market premium for risk again?
Market premium
For
oh,
risk.
for risk. That is RM minus RF. Market
Ah,
return minus risk-free return. Yeah,
okay, okay. Thank you.
welcome. Okay, are we all good with this? Okay, here is a case study for you. Maybe a simple case study. Okay, I have actually put some data there. Let me just get rid of the data and let's see if you can go back and find back the data. Yeah. Uh, let me delete this. Let me delete this. Yeah. It's okay if you can take a quick peek at it, but I'm sure you will be diligent enough to work it out yourself. So WIC Berhad, which is a world famous company, is listed on Bursa Malaysia, a Malaysian stock exchange. It has 70 million shares in issue. The current share price is 5 ringgit per share. The company also has issued 7% irredeemable bonds. Irredeemable, so we don't have to pay back. Well, not really. Yeah, it means that you're not going to pay back in the foreseeable future. You're probably going to convert them into shares. Yeah, and these bonds, they have a total market value of 100 million. So the shares are 70 million at 5 ringgit, and the bonds are 100 million. Now, an investment bank has computed the required return on these bonds as 5% after tax. And that should be music to your ears because they have already done the adjustment for tax. Yeah, so it's after the tax benefit. The shares have a beta value of 1.18. Average returns on Bursa are 18%, and government treasury bills provide returns of 4%. Yeah, so compute the cost of capital for WIC Berhad, which may be used as a discount rate to evaluate projects. So in the morning, I gave you all the data. Now I have given you an example where you need to work out some of the data yourself. What is the data? It does not change. To calculate cost of capital, you need E, the total market value of equity, D, the total market value of bonds, V, which is E plus D, proportion of equity, proportion of debt. Then you need KE and you need the KD, net of tax benefit. Why? Because you're going to do a weighted average of these last two numbers. And your weighted average is based on the market values, proportionate market values that you calculate here. So these are the proportions, these are the values which of which you are going to work out a weighted average. 5 minutes head start for you. Then I'll start keying in the numbers. Okay, let's see. E, total market value of equity, should be 70 million shares. Yeah, 70 million shares multiplied by 5 ringgits. And that is what? 7535, 350. Bonds are given. Valuation is given here. How much is that? 100 million. 100 million, there you go. Therefore, this is E plus D, which is 450. Therefore, proportionate value. And again, just to remind you, that's 350 divided by 450, yeah? And this one will be 100 divided by 450. That's equal to 350 divided by 450. We get 0.7777, 0.78. Yeah, and those of you who are mathematically inclined, you will know if equity is 0.78 proportion, and therefore bonds must be equal to 1 minus 0.78, the rest of it, which is 0.22. Yeah, you can do it that way too. Or you can do 100 divided by 450. So that's as far as proportions are concerned. Please notice I put my proportions as a decimal. My returns I put as a percentage. Why? Again, to make life easy, you should remember that when you take a proportion, multiply it by a percentage required return, you will get a percentage. Yeah. So decimal multiplied by percentage, the answer is always percentage. There you go. So now KE, for KE, I have to substitute in the CAPM formula. The beta value of the shares is 1.18. The market returns are 18. The risk-free returns are 4. So KE is equal to, yeah, this is equal to 4% plus beta value 1.18. Doesn't matter if you put beta before or after, multiplied by, what's the market premium? 18% market returns minus the treasury bill returns, which are 4. So market premium is basically 14, yeah, percent, close brackets, yeah, and that would give us, let's see, equals to 4 plus 1.18 multiplied by, the premium is 14, isn't it? Yeah, 14. So that gives you 20.52% KE. Hopefully we all have the same number. And KD1 minus tax, as computed already for us, is 5%. Yeah, 5%. So then we can now happily compute our cost of capital, yeah, and say K0 is equal to 20.52%, which is the cost of equity, multiplied by the proportionate value of equity, which we calculated as 0.78, plus 5%, the cost of debt after our tax benefit, multiplied by proportionate value 0.22, and well, that should give us, see, once again I will do it so that you can see it happening. 20.52 multiplied by 0.78 plus 5 multiplied by 0.22. What did I do? 20.52 . Oh, maybe this was percentage. We don't want percentage. make this general, 17.10. Yeah, that's more like it. 17.1% cost of capital. So please remember, cost of capital is just our guideline. Yeah, it's our guideline to tell us that this required return from investments must be more than 17.1%. In practice, you will find that our discount rates are often 2-3% higher also. So if we, let's say we got a calculation of 17.1%, our discount rate could be easily 20%. Yeah, many American and European companies actually they bump it up 2 or 3% higher. Yeah, but for the purpose of your calculation, if you want to propose this, you might just round it up if you want, or if you want to bump it up to, I think that should be acceptable because that's what happens in real life. Yeah, so please remember, actual discount rate is always higher than cost of capital. Why? Because we want to make sure that we cover all the required returns that providers of long-term capital give us. Any questions at all? Any questions at all?
Regarding the KE,
Yeah.
It's about the 4% plus 1.18 times the 18 minus 4%, right?
Mm.
It's 12. 18 minus 4, 14.
Don't forget 18.4 is in brackets first. Huh? Remember the BODMAS rules that your teachers taught you. Brackets first.
Okay, got it.
Yeah, 18 minus 4 is 14. That's the market's premium for risk multiplied by the beta value for this company, 1.18, and then add on to the risk-free return, 4%. Okay?
Got it.
Okay.
Thank you.
Welcome. Anything else?
Doctor,
Yep.
want to ask the donkey as giving 100 million, you take from the one you mentioned, is actually 70 million divided by 7%.
No, it doesn't have to be that. But that is one way of working out the value of bonds. So you are asking me, would this mean that value of a bond, yeah, is equal to, well, let me just put this down so that everybody knows what we're talking about. Value of a bond normally is the coupon payment of interest divided by required interest yield, which means your KD before your tax saving. Yeah, required interest yield, and then of course all of this multiplied by 1 minus tax. Yeah. Yes, then that would be the value of a bond. And did I get it like that? No, I just hantam only 100 million. Yeah, but you could do this if you wanted. You could do this. And so now that you know that they are 7% bonds, and if you knew what was the required interest yield, and if you could work out a market KD for it, for instance, yeah, because you see here the market KD given to us is how much? 5%, is it? Is it 5%? Yeah, 5%. So if you have taken, let us say, for discussion purpose, yeah, if you had taken the coupon payment interest rate 7% for every 1,000 ringgit bond would be 70 ringgit. Yeah, it would be 70 ringgit divided by, since this is already adjusted for tax, yeah, since this is already tax adjusted, so I would say this is 70 multiplied by um, 0. We don't know the tax rate. That's the problem. Then we can only do a guesstimate. Yeah, 70 divided by 0.05, which is an after tax rate. Yeah, um, after tax rate. That won't be right. No, because we don't have data. We don't have data. Yeah, we couldn't do it. Anyway, that's how you would do it. Yeah. In this case, no, it's not actually fully calculated because we don't know the tax rate. We don't know the actual market value of each individual bond. I've just given you the total market value of bonds because that's the only information we need here. Yeah. We'll see how that valuation works, maybe in a separate discussion. Is that okay? Any other questions, please? All good. Okay. Short washroom break for you, and then I will continue. Yeah. I have put a few more examples here for you to work through with the answers. Now, although I have recommended to you that you should use CAPM because beta values are available and it's an easier model, but sometimes for some companies you may be given dividend returns. So if you are going to use dividend returns, how do you work out dividend returns? Just now we saw KE calculated on basis of market risk. Now we are going to see KE based on a growth adjusted dividend yield. Dividend yield is something which we already do, isn't it? It's dividend over share price, something we already do. But if you make it a growth adjusted dividend yield, then it becomes a KE. Yeah. And by the way, there's some contact information there, but WhatsApp only, please. Yeah. Thank you. Okay, 5 minutes break time. Okay, then let's continue our discussion. We talked about calculating the cost of equity or returns on equity using the capital asset pricing model. So, higher the beta value, higher you would expect the cost of equity to be. You can also work out KE based on dividend yields adjusted for growth. Yeah, let's see how that works. Returns are based on dividend yield, and KD is the coupon rate paid on bonds adjusted for tax benefit. Yeah, and so we'll come back to the discussion that we were having just now. Why is this here like that? Maybe this should be here. Yeah. So the formula is simple. You need to remember a couple of formulae here. Cost of equity is next year's dividend divided by current share price plus the expected growth rate in dividends. Yeah, I've purposely written this down in English so that you can see the logic of it. Yeah, next year's dividend divided by current share price plus the expected growth rate in dividends. Why next year's dividend? Because this model is derived from a share valuation model, and when you value shares, one of the methods of valuation is called the dividend discount model, DDM. So DDM discounts the future stream of dividends to its present value today, and discounting usually starts from year one. So we take next year's dividend, yeah. And cost of debt is the same thing, is coupon payment divided by current bond price multiplied by 1 minus tax, which is derived from just now the valuation formula that I put up there. Okay, so let's take an example. WIC PLC is listed on the London Stock Exchange with market valuations of equity at 500 million pounds, and bonds have a market value of 300 million. So happily for us, we already know that E, equity, is 500 million sterling, bonds, D, is 300 million. Yeah, the shares have just paid dividend, and based on the expected growth rate of dividends, next year's dividend will be 0.83. So we already know next year's dividend. Growth rate is expected at 3%. How we calculate this growth rate, we will talk about it presently. And this is expected to continue indefinitely, with shareholders expecting current share price of 1550 to go up, obviously. Yeah? The bonds have are 6.5% irredeemables and enjoy a tax rebate on interest paid of 24%. So we have our E. Once again, please notice I always have that same structure. What is equity? What is debt? What is equity plus debt? What is the proportionate value of equity out of total capital? So E over E plus D. What is the proportionate value of D as a decimal? So in this case, 500 out of 800 is of course 0.625, and the balance is 0.375. KE, next year's dividend here, 0.83, yeah, divided by current share price, which is £15.50, and plus 0.03, yeah, plus 0.03. Why? Because we want to, yeah, well, if I don't do this, if I just make a gap, then I should be alright. Because I want to show plus, so that's why I did that. Yeah, alright. Yeah. In order to keep it as a text, I have to do this. Plus 0.03. So this part here, 0.83 divided by 15.5 is 0.054, plus 0.03, which is the growth rate, becomes 0.084 or 8.4%. Yeah. So that is just to find your KE first. Then when you want to find your KD, 1 minus tax, par value of one debenture unit. In UK it's 100, in Malaysia and New York it's 1000. The coupon payment is 6.5%. So that means for every £100 sterling, the interest actually paid, the coupon or contractual payment of interest, will be £6.50. Yeah, therefore KD will be equal to 6.5% multiplied by 0.76. Excuse me. Does everybody know where we got 0.76 from? 0.76 is 1 minus the tax rate. Tax rate is 24%. 1 minus 0.24 is 0.76. Yeah? So once you become clever, you can just write it like that. 6.5% multiplied by 0.76 gives you 4.94. So we want to get a weighted average of 4.94 here for KD, net of tax, and KE 8.4%. What's the weighted average? Weighted average means the number must be somewhere between this and this. Yeah. If you are doing a weighted average and suddenly your number is bigger than this or smaller than this, then obviously you have pressed the wrong key on your calculator or on your keyboard. Yeah, then you need to check it again. So in this case, K naught, it will simply be the cost of equity, 8.4%, multiplied by the proportionate value of equity, which is 6.625 plus 4.94, the cost of debt net of tax benefits multiplied by 0.375, and we get 7.1. Now, if you are keeping a notebook and keeping a calculator close by, I hope you're also checking my calculations as we go along. Any questions on this? This is an income-based model. Yes?
Dr. Harvey, how do you get the 3% growth rate?
I think it is given in the question. Yeah, growth rate of 3%. That's
so in actual, how do we actually analyze the company's growth rate? Yeah.
I show you now, yeah?
Thanks.
Right.
I got one question.
Yep.
How about the power? Just now you said for UK power use £100 right?
Yeah.
In Malaysia,
Debentures. Debentures are £100. For us, our loan stock debentures are 1,000 ringgit.
So the coupon payment must be calculated. Let's say here 6.5%. If in Malaysia, it will be
65 ringgit. 65 ringgit.
Great, thanks.
Welcome. So there's another example for you to work out in the pleasure of your own home. And now to answer the question of the young lady just now, estimating the growth rate of dividends. Yeah, I'm sure young lady, because I think I'm older than everybody here. Let me just bring this closer. How do we estimate the growth rate of dividends? Well, there are two main models that in corporate finance we are encouraged to use. One is we extrapolate the past dividends, meaning to say we look at how dividends have been growing over the past 4 periods. 4 periods means 5 years. You see, this year to the last year is one period in between. Last year to the year before that is a second period. So like that, if I keep going for 5 periods, 5 balance sheets if you like, I'll get 4 periods, you see. This is current dividend, this is dividend a year ago, this is dividend 2 years ago, 3 years ago, 4 years ago, but there are 5 accounts that report this dividend. Yeah. So, for example, if APLC had just paid a dividend of 88 cents and current share price is 888, all very long numbers here. The dividend payment pattern for this company over the last 5 years is as follows. So compute the KE for this company. So now to get the KE, we will need next year's dividend divided by current share price plus the growth rate. We know the current share price is 888. We know the current dividend is 88, but we need to find next year's dividend. And next year's dividend will be this year's dividend multiplied by 1 plus the growth rate. So, which means we need to work out the growth rate first. Now, the formula for growth rate is nth root of latest dividend divided by earliest dividend minus 1. Yeah. Where n is the number of periods, which in this case is 4. Nth root, so fourth root of 88 divided by 68, fourth root of that minus 1. Yeah. And well, yeah, okay, I have done it here. So that is, what have I done here? No, this is some other number. I don't know why I have it here. Let me just delete it off. Maybe I did it as a sample. Yeah. So in this case, it would be equal to the current dividend, which is 0.88, divided by the first dividend in this series, which is 0.68. Yeah. Fourth root means to the power of a quarter. Power of 1/4. There you go. and the whole thing minus 1. Yeah. So let me put another big bracket outside here. Whole thing minus 1. Minus 1. Did I get it? No, I didn't put the bracket, did I? Yes. To the power this one, minus 1. Now it's correct. So I get, 0.665 da 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 da. Or if I just bring it to maybe 3 decimal places, 0.067. Yeah. So I can say G is equal to 0.067. Everybody okay with this growth rate? Any questions?
Doctor, how
Yes,
do
yes.
we know we need to use the 1/4?
Because 4 periods. So if it is 5 periods, 1/5. But normally in the accounts they will give you the 5-year summary, isn't it? So 5-year summary means we will that's 4 periods lah. So normally you will be using to the power of 1/4. Yeah. Or if you have like a scientific calculator, you can put there root 4. Yeah, if you want. Yeah. That's how
Thank you,
we
Doctor.
Any other question? All okay with G, yeah? Okay. So now we just want to substitute these values into the formula. The base formula I told you is next year's dividend. We want next year's dividend divided by current share price. In this case, in this example of mine, I have only put in the current share price. I have not put in the next year's share price, which means to get next year's share price, I'll take current dividend, 88 cents, and I will multiply it by 1 year of growth. Yeah, because next year's dividend will be 106.7% more than the current year's dividend, isn't it? It will be 1.067, 6.67%, 6.7% more than the current year. So 1.067 is saying that next year's dividend will be 106.7% off this year's dividend. That's why I take 0.88 multiplied by 1.067 divided by the current price, which is 888, and then plus G again. So you see, dividend yield, normally you just take dividend over share price, isn't it? There's no discussion of a growth rate. But for this purpose, we will actually put that in. Yeah. So there you go. And then we get KE as 17.27. That's it. Easy enough. Any questions at all? Okay, good. So that's KE. This is one growth rate model. The other growth rate model is the Gordon's growth rate model. You'll remember yesterday evening, I talked to you about sustainable growth rate. The sustainable growth rate formula is actually based on Gordon's growth rate model. So Gordon said, how much dividends you can pay in the coming years, in the future, cannot be dependent on your dividend payment history. He is one of the guys who was very critical of this model. And he's not the only guy. Many people are critical of this model. And certainly, there are a lot of flaws in this model, because you are assuming that just because we achieved a 6.7% growth rate over the last 4 periods of 5 years, we will be able to continue to do this forevermore. And the proponents of this model, the mathematicians who say it's okay to use this model, they say, yes, we know maybe we exaggerate the dividends themselves a bit more, but look, we did not take into account capital gain. What about capital gain? Obviously, if dividends are growing, there will be some capital gain. So we have indirectly taken into account capital gain as well. Yeah. Well, it's very arbitrary, isn't it? It's very arbitrary way of taking capital gain into account. But well, there you go. It is accepted in the world of corporate finance. Yeah. And so Gordon said, this is not right. You are taking past dividend history and assuming that this will continue in the future. What you should do is, you should ask yourself, what is the capacity of this company? What is the ability of this company to continue paying dividends in the future? Yeah. What is the capacity of this company to continue paying good, healthy dividends into the future? And he said the answer is two things. Number one, how much profits are available for shareholders, that's ROE, and how much of those profits are then plowed back into the business, retention rate of profit, which is also sustainable growth rate. Yeah. So when you are looking at it from a valuation point of view or a funding point of view, then you talk about it as a sustainable growth rate. When you talk about it from cost of capital point of view, then you acknowledge Mr. Gordon. Yeah. Professor Gordon is a British professor. He said that growth rate of dividends will be based on ROE multiplied by retention rate of profit. So you need only 1 year's data. That's the other good thing about this model. You don't need like the last 5 years. And retention rate is of course distribution divided by profit after tax. Let's take an example. BPLC has reported profit for the current financial year of 20 million. Yeah, the net book value of equity is 100 million. So their profit 20 million, book value of equity 100 million. So what is ROE? 20 million divided by 100 million. Yeah, profit over equity, ROE, return on equity, is 20%. The company has declared dividends of 10 million. So half of this is going to be distributed as dividend. And the rest half is going to come back into the company, reinvested into the company. So what would be the KE if the company has 50 million shares in issue and the current market price is 9 ringgit, yeah, of each share? Ringgit. Let me make it like that. Looks prettier. Yeah. So we know KE is next year's dividend, which is current dividend multiplied by 1 plus G divided by current share price plus G. Yeah. And the background information to work out G first. Well, to work out G, we know that return on equity is profit after tax over equity. There's 20 million divided by 100 million, 0.2 or 20%. The retention rate, in this case, 50%. Yeah. But because we call it a retention rate, it might be an idea to just put it as a decimal. So that when you work out the growth rate, you will say growth rate is 0.5 multiplied by 20% or 0.2, which gives you 0.1. Growth rate 0.1. After all, we are going to take growth rate as a decimal in this formula also. So it's fine to leave it as a decimal. Yeah. And so if KE is the current dividend 20 cents multiplied by, how did I get 20 cents? Because dividends are 10 million and there are 50 million shares. So when you work it on a per share basis, 10 million dividend divided by 50 million shares is 20 cents per share, multiplied by the growth rate, which is 1.1, since it's 10% growth, divided by 9 ringgit, which is the current share price, plus the growth rate again, 0.1. And that should give you 0.1244 or 12.44%, your cost of equity. Does it check out? When you do it, when you do the math on your calculator? It's for here, I think. Okay, checks out, yeah? Good. Now I have a good full working example here for you. So can I give you all 5 minutes head start perhaps before I jump into the discussion, and then I'll show you how to work out KD. KD is usually worked out using income based model. Yeah, we don't use beta for KD. We use beta for KEs. It's friendlier with the equity. Yeah, and maybe for now I can close this so that I can get better exposure. Yeah. So listed company has 75 million shares in issue, and the current ex-div ordinary share price is 730 per share. Yeah. Is one of the past year questions actually, yeah, from one of the professional papers. Enviro Green Berhad also has in issue bonds with a book value of 20 million. Their book value is 20 million, and their ex-interest market price is 108 per 100 ringgit bond. So you do the math to calculate what is the market value of bonds. Up until now, I've just been giving you the market value, isn't it? So for this question, you will need to work out the D. Yeah, do a bit of work on that. The bonds pay annual interest before tax of 6%, and they will be redeemed at par in 7 years' time. So you will need to work out KD using an internal rate of return methodology, which I will show you. The tax rate is 20%. The equity beta of the company is 1.3. The yield on short-term government bonds is 3.5%, and the equity risk premium is approximately 4%. Please note the words very carefully. Yeah? The board has decided to decrease the weighted average cost of capital and hence increase its market value. And they want to issue 50 million bonds at their par value of 100 ringgit per bond. The after-tax cost of debt of the new bonds will be 4%. Don't worry about the last paragraph. I think if you can work out the proportions for me and KE for me, I'll be happy. Just this part, this little corner. Then I will show you how to do the KD. Yeah, and I'll go through the maths. I've already done it to save time, but I will go through it with you. Yeah. So calculators out, please. Yeah. All right, 75 million shares in issue. Current ex-div ordinary share price is 730. So I think equity will be equal to 7.3 multiplied by 75 million. So answer in million would be RM million 547.5. Yeah, this is RM millions equity. Debt would be you see now for debt, bonds have a book value of 20 million and their current market price is 108 per 100. Basically, this means that whatever is the market price, it is 108% of the book value, because 108 per 100, per 100 means percent term, yeah, percent. So the debt here will simply be 20 million multiplied by 108 divided by 100, because 108 market value for every $100 of book value. And once you become clever, you can just multiply by 1.08. Yeah, once you understand this, you'll get 21.6. Very small amount of bonds compared to the market value of equity. Yeah, so the value will now become 547 plus the bonds 21.6, 569.1. Yeah, everybody okay with this?
Yes.
Isha, all good, yeah? And so equity proportion will now be equal to 547 divided by 569.1, which is 0.96. Let's move that up a bit. And then this is, of course, 1 minus equals 1 minus 0.96, that's 4. Okay, what is the KE? KE based on the equity beta 1.3, yield on short-term government bond is 3.5%, 3.5%, plus, now because this is an exam question, so the language is a bit tricky. The beta equity is 1.3, no complication there. Then this should be multiplied by market premium for risk. They have already given you the equity risk premium is 4%. Yeah. So here you don't need to work out the market return or anything like that. They already given us the market risk premium 4%. Yeah. So we can take 4% straight away, and then we would get let's see. Maybe I should not be so open with this. Bring this closer. Bring this closer. Okay, now let me see. Yep. That would be equal to 3.5 plus 1.3 multiplied by 4, yeah, and that's 8.7. So we got KE. Now KD, we are told that these bonds will be redeemed at par in 7 years' time. Now, if in your calculations you find that they have some sukuk or some bonds that are due within the next 10 years, then you will have to do this calculation. And because you will also know the redemption information. Redemption means repayment information, yeah? How do we work out cost of debt under those circumstances? We work out what we call a gross redemption yield, yeah? This KD here is a gross redemption yield. That means the yield on the bonds from now until their redemption date, yeah? What we do know is that the current price is 108 per 100. The interest paid is 6%, so it's 6, yeah. since they have already said this is 100 ringgit bond, so we just stick with that 100 ringgit. Then net of tax cost to the company. How many percent is the tax rate? Is 20%. Yeah. So net of tax cost to the company would be 480 or whatever, if you want to take that. Yeah. Alternatively, you can just put that down here in the schedule to work out your IRR. Yeah, I don't know how much of your IRR or NPVs you remember. I will revise a little bit of that tomorrow, the NPV part. But anyway, IRR works like this. Whenever an investor buys a bond, there are always three cash flows that are involved. And the three cash flows are the market price that you have to pay. So there's 108 out of pocket you pay. Then you earn interest for 7 years in this case, 6 ringgit. And at the end of the 7th year, you get back your money. That's the redemption, 100 ringgit. So now you want to find out what is the value today of these cash flows. There's an investment of 108 today. Interest at 6 ringgit is going to be earned for 7 years, and then there will be redemption at the end of the 7th year. So what is paid out today? The discount factor obviously is 1. I have taken 6%. Why? Because these are 6%, isn't it? The bonds. Yeah, 6%. The bonds are 6%. So this is what my lecturer taught me too many years ago, that if they are 6% bonds, you know that the redemption yield will be around 6%. So it's a good starting point. This is actually literally a trial and error method. So you really need to make just any percentage discount rate that you want to use. Yeah. So the best one is to use whatever is the cost of interest on the bonds. So we multiply by 6% discount rate. Because this is year 1 to 7, it is a NVT. So I look up the NVT factors, and in the notes and manual that we have uploaded for you, we have given you both present value factor and NVT factor. Yeah. So at 6%, it is 5.582. Yeah. Let me just show you how this might work. NVT table. Yeah. Oh. So tiny. This is present value table because it's 0.91. Oh, wait a minute now. This is an NVT factor table. Okay, so this NVT factor table, copy, just to give you an illustration. Yeah. So if I put it out here, the last time I calculated the factors, today I will just show this to you. So this is what you're probably going to do. Yeah. So we need 6 years discount rate. There you go, 6 years, and 6%, and we want it for 7 years. So you can see 6%, 7 years, 5.582. Yeah, you get the factor, or you can calculate it also. Excel can calculate it for you, which I have done here. So year 7, you see 5.58238, 5.582. Yeah. So the discount factor for cash flows from year 1 to 7, you know, is 5.582. There's evidence there. So to get the value today of 7 payments of interest of 6 ringgit, how much would it be worth in today's terms, in present value terms? Answer, 6 ringgit multiplied by 5.582, you will get 33.49. Yeah, and then in the 7th year, there's a single cash flow of 100. So for that you need a discount factor 0.665, and again if I just show you what I've done here, year 7 0.665, yeah, that is following the discount rate formula. Yeah, so if you want to generate your factors, you can use back this Excel worksheet to do it, or you can look at a table. Tables are available in your notes, and they are available on Excel on Google. Yeah. So of course 100 times 0.665 becomes 6650. When we add this up, we find that the net present value of bond cash flows at a 6% rate is negative. Now, if it is negative, like we said last night, if the net present value is negative, it means that you have not achieved the 6% return. If this was 0, it means you exactly achieved 6%. And that's what you want to find out. You want to find out what is the rate at which NPV will become 0. Then that will be the internal rate of return of these cash flows. But here, when I discounted at 6%, I found it is negative. So I know I must discount at a lower rate. So here I have tested the cash flows at 3%. I did the same thing, market price, interest, redemption, but I used the factors now at 3%. Year not 1, this is 6.23 now, and 0.813, and I find I get a positive number. So now I know that the returns on these cash flows are somewhere between 6% and 3%. Because when I test the cash flows at 6%, I get a negative NPV. When I test them at 3%, I get a positive NPV. And I changed my discount rate by 3%. By changing my discount rate 3%, my net present value from minus 8.01 went through 0 to 10.68. So the total change in my net present value over 3% was 18.69. Now, if I know that by changing the discount rate 3%, I get an NPV change of 18.69%. I can then find out the rate of change. So I take 18.69 divided by 3, because this is the change over 3%, and I'll get 6.23. So I know if from 6% I come down to 5%, then my NPV will increase by 6.23%. So it won't be minus 8.01. It will be maybe minus 1 point something only. Yeah. So I want to know where it hits the 0. Well, you do a simple rate of change calculation to get the IRR. The IRR is simply the discount rate plus the NPV at this discount rate divided by the rate of change. So if I start with the 3%, IRR is 3%. What was my NPV at 3%? 10.68%. Yeah, and the change over 1% is 6.23. So 3% plus, because now I know my KD is more than 3%. So plus 10.68 divided by 6.23, I'll get 4.71. Yeah, so this would be my gross redemption yield. This is called KD before tax benefit, or in the stock market we call this gross redemption yield. Yeah, redemption yield. And then of course, because we are taking this in for our K0 calculation, I will make the tax adjustment, tax saving adjustment, which is 0.8. I get 3.78. There you go. So now we said equity proportion was 0.96. We did that earlier. Bonds were 4%. The value was 569. The KE was 8.7 based on our CAPM. And now we have worked out the KD to be 3.78. Therefore, our existing weighted average cost of capital for this company is 8.5%, yeah, based on this formula. Now, if you bring in the new bonds, then you do the same thing. You assume that the KE is unchanged, and then you can get the K0. Yeah, I will leave that for you to work out. Any questions at all on this? I know it's a bit heavy for a Saturday afternoon, but that's it. The toughest part is over now. Any questions at all?
Sir, on the redemption, why
Yeah.
has it changed from 0.665 to 0.813? on
Why
the
has it
tables?
why has it changed from
0.665? It went to 0.813 on the T7.
because the discounting rate is different. You see, you're testing the cash flows at 6%. When you are discounting at 6%, you are asking yourself the question that if I was an investor buying this bond, would I get a 6% return on these bonds? The answer is no, I won't. How do I know that? Because my final, when I add up all my present values, it's negative. Then I say, okay, fine. Now let me test it at 3%. If I buy these bonds and I test the cash flows at 3%, will I get a 3% return? Answer, yes, you will get 3% and a bit more than 3%, because here it is not zero, it is more than zero. Yeah.
Sorry, the question was, where do I get the 0.665, the value in the table?
It's the amount multiplied by the discount factor from the table. From where? From here, there. Just now I showed you. 0.665. There you go. I've worked out year 7. 0.665.
Okay, thank you.
But if you want to see a table, let me put the table also lah. No worries. Yeah. That is called present value table. Just now I looked at NVT table, isn't it? For a series of cash flows. Then you look at present value table, PV table. PV table. This one looks a bit bright and nice. Is this PV? Present value, yeah. So then I would use a slightly different table. And these tables are in your manual, you know. Yeah, we have already put them in your manual. Present value of $1. Let me make it a bit smaller so that it fits into everything that we are doing here. Yeah. So there you go. 3%, we wanted 7 years, right? Present value of $1 at 3% for 7 years. 3%, 7 years. There you go. It becomes 0.81309. Yeah. So we got the 813. Yeah. And this 665, if you are testing it at 6%, so let's go back here and see 6%, 6%, 7 years, 6%, 7 years, 665. Yeah. So these are the tables that you. So these are just mathematical filters to see what, to measure what is the return that investor will get if they buy the bonds of our company. So to wrap it all up, how do we calculate cost of capital? How do we work out the required rate of return for new investors, for new investments? Answer, listed companies can look at the stock market and look at their shares on the stock market and then say to themselves, well, look, these are the returns that people are getting on our equity shares, and people are buying and selling the shares at this rate of return, which means they are happy with the kind of returns that they are getting. Yeah. So that would be the KE that they are looking for. Because that is the return that they are happy with. So that must be the required return on our equity. So we collect that. Then we collect the data relating to our bonds. What is the required return on the bonds? And we saw just now, we can work out the required return on bonds by testing the cash flows from the bonds with different discount rates until we get the IRR, the internal rate of return. Yeah. Once we have that, we can then do a weighted average of the two. And once we got the weighted average of the two, that will give us the overall cost of capital. Our discount rate must therefore be a percentage higher than the cost of capital. So if your cost of capital is 10%, you might want to use 12, 13, 15%. If it's 17%, you might want to use 20%. We always bump up the cost of capital by a few percentage points when we want to evaluate our capital investment projects. Yeah. And that's how the cookie crumbles. Are we good? All okay? Okay, I hope you have been able to take down some notes. And tomorrow, I will start talking a little bit about the theories. Sunday morning, morning, I will start off with some theoretical discussion. And then we will also look at the 6 capitals. We will see how the 6 capitals apply in real life. We will take some examples, maybe Sime Darby and a few other companies. And then in the afternoon session, I will go through the assignment with you. Yeah, that's the plan for our Sunday. Yeah. Okay, so please take a good cup of teh tarik or something like that, and freshen up a little bit. Go for a jog, walk, or whatever, and then come back and just try to go through what we have done today, so that if you have any questions, then I can address them for you straight away tomorrow morning. Yeah. Thank you very much indeed. Good night.
Thank you, Doctor.
Thanks, Doctor.
Doctor.
Thank you.
Thank you, Doctor.
Thank you, Doctor.
Thank you.